Real estate investment trusts were created in 1960 in the United States with the aim of offering citizens an accessible way to participate in the real estate market and benefit from the income generated by real estate properties. These instruments allow individual investors to acquire or finance properties in a similar manner to how shareholders benefit from owning shares in a company. Shareholders benefit by receiving a portion of the income generated by the properties, without the need to directly acquire or finance a real estate property. This structure enables investors to participate in the real estate market through stocks, providing an opportunity to earn money through distributed dividend. They are divided into three main categories: equity REITs, mortgage REITs, and hybrid REITs. Let's start with equity REITs, which acquire properties such as office buildings or shopping centers and lease them to generate regular income through rents. Secondly, mortgage REITs do not directly own properties but invest in mortgage loans. They lend money to finance real estate purchases and earn income through interest payments on those loans. For example, a mortgage REIT may provide loans to individuals wanting to buy homes, generating stable income from interest payments without the direct responsibility of managing properties. Hybrid REITs combine both strategies, having properties in their portfolio and also investing in mortgage loans. This combination allows them to diversify their income sources, earning rents from properties and profits from loan interests. An example of a hybrid REIT could be owning a shopping mall while also providing mortgage financing for real estate projects, benefiting from multiple fronts in the real estate market. To operate transparently and securely, a REIT is required to register with the Securities and Exchange Commission (SEC). As part of this process, the REIT must provide a detailed overview of its business, including financial aspects, information about its management team, and a thorough assessment of potential risks associated with its activities. This information is crucial as it allows investors to gain a deep understanding of the REIT, facilitating an informed decision-making process before making any investments. Being a bit more technical, it is important to emphasize that REITs have some rules to follow. They must distribute at least 90% of their income to shareholders in the form of dividends, ensuring that shareholders receive the majority of the income generated by the REIT's properties or loans. By distributing 90%, REITs avoid corporate taxes and structure themselves as passive investment vehicles. Also, at least 75% of the total assets of the REIT must be invested in real estate, mortgage-backed securities, and other real estate investments, ensuring that REITs are primarily involved in the real estate business rather than other forms of investment. This maintains the integrity of the main purpose of REITs as real estate investment vehicles. No more than 5% of the gross income of the REIT must come from a single source, and no more than 20% of total assets must be invested in unrelated real estate. This prevents excessive dependence on a single income source or overly concentrating in a specific type of property. Diversification reduces risk and improves fund stability. The REIT must have at least 100 shareholders and cannot be dominated by a small group of investors who may own more than 50%. This prevents a small group of individuals from controlling the REIT, promoting the participation of a larger number of investors and contributing to transparency while reducing the risk of manipulation. REITs have outperformed most investments, and their popularity is due to being one of the safest and highest returning investments available, with protection against inflation. All good so far. However, before rushing to buy any REIT, you should know that, apart from what I mentioned earlier, this remains a fairly vast sector. You must be quite selective when investing in a REIT because, like any investment, if you don't research well, you could lose your money due to poor selection. So, I will explain some tips that will help you be more precise when selecting the REIT in which you want to invest. One of the most common mistakes when considering investing in a REIT is excessively focusing on the expected dividend yield. It is often mistakenly assumed that a high dividend yield automatically translates into higher long-term returns. However, in most cases, the opposite is true. The perception of high returns can be driven by various factors, such as an unsustainable payout ratio, excessive leverage, or problematic assets. The payout ratio, which is simply the proportion of earnings distributed as dividends, can be indicative of the financial health of the REIT. An excessively high payout ratio can be a warning sign, as it suggests that the company may be distributing more than it can sustain in the long term. This could be due to poor financial management, excessive debt burden, or problematic assets in its portfolio. In many cases, higher dividend yields can be misleading and end up being less attractive than those with a more conservative approach or a lower payout ratio. A lower payout ratio allows the REIT to reinvest in growth and acquire higher quality assets, which can result in higher long-term profits and greater financial stability. Moreover, confining investments solely to U.S. REITs may overlook numerous opportunities available in other countries. There are REITs operating in approximately 30 nations, many of which are relatively new and face considerably less competition. In some countries, REIT investment may be considerably less common than in the United States, meaning that investment opportunities in foreign REITs could be significantly more attractive than those available in the United States. In every investment, there are risks, some of which may arise due to inadequate management by third parties. A common mistake is assuming that all REITs are well managed simply because we believe that the team overseeing the management, handling so much other people's money, will be responsible. However, the reality is different. While some REITs are well managed, others prioritize the interests of the management team over those of the investors, which can lead to significant losses for shareholders. Therefore, it is crucial to carefully evaluate the management team of a REIT, even above factors such as property quality, leverage, or distribution ratio of profits.